basically, this strategy will show clients how to invest with 80-cent dollars as opposed to 55-cent dollars. Instead of investing with personal after-tax dollars, and if you are taxed at 45% on your top marginal rate, then you only have 55-cent dollars left to invest. If your corporation eligible for the low rate of tax is taxed at about 17%, but let's say 20%, and you are then left with 80-cent dollars to invest. And basically, you would dividend those after-tax dollars up to a holding company. And intercompany dividends, as you're going to see, aren't taxable. Tax shelter your investments by using a life insurance contract where the cost of the life insurance has to be less than the money you would otherwise pay in tax. It's going to show you how to effectively provide you with a tax-free income at retirement. Also, but very important, protect your assets from creditors and litigation. Instead of paying tax, we're going to increase the value of your estate. What's the solution? Well, set up Invesco. It's another corporation. So you still have Holdco, but you set up another company called Invesco. The Invesco shares would be owned by you, the same shareholders as OpCo. So assume that OpCo had paid tax at 17% and had $150,000 left over, not used for working capital. So it's a non-active business asset and it's cash. So one method is for OpCo to restructure the shares to create a class of high-low preferred shares. OpCo would pay a dividend to its common shareholders of only $100. They pay tax on a dividend of $100, which dividend would be satisfied by the issuance of $150,000 worth of these special shares. The amount of the dividend for tax purposes, remember, is only $100. Alternatively, the common shareholders could exchange their shares under Section 51 or Section 86 of the income tax for high-load preferred shares and common shares of another class. So the holders of the $150,000 worth of shares, preferred shares, would sell them to Invesco on a tax-deferred basis under Section 85. OpCo would then redeem the preferred shares held by Invesco by paying $150,000 in cash. Redemption is a dividend. When a private company buys the shares back, remember we said it's a dividend of $150,000, but there would be no tax because it's a related company. This means $150,000 of cash from the operating companies now sit in Invesco.